Every dollar of Social Security you collect this year was already taxed once, and the IRS is about to tax up to 85 cents of it again, using a threshold that hasn't moved since 1993. Marilyn Kowalski is 71 years old. She lives in Scottsdale, Arizona. She spent 29 years as a school librarian in the Scottsdale Unified District, put every dollar she could into her state pension, and retired in 2021 with $680,000 in a rollover IRA, a $1,900 a month Social Security benefit she spent 4 decades earning, and a silver 2016 Honda CR-V that still has the original tires. Every Christmas, she and her daughter spend 2 days making tamales from scratch in Marilyn's kitchen. She is careful. She is organized. She has a folder for every financial document she has ever received. Marilyn did everything right. She took Social Security at 67, full retirement age, to maximize her benefit. She started drawing $36,000 a year from her IRA to cover living expenses. She set up a budget. She hired a tax preparer who does her 1040 every April. And every April, Marilyn learns the same thing she learned the April before, that $16,150 of her $22,800 annual Social Security benefit is taxable income, that the federal government is taxing 70.8% of the benefit she paid into for 29 years of payroll deductions. Marilyn does not understand why. Her tax preparer said it was just how it works. Nobody explained the provisional income formula. Nobody explained the cliff. Nobody explained that the threshold triggering that tax was set in 1993, 33 years ago, and has never been adjusted for inflation by a single dollar. Here is what Marilyn doesn't know yet. If she reorganizes 3 specific income streams before December 31st of this year, moves that are legal, documented in the tax code, and available to every retiree in her situation, she can reduce the taxable portion of her Social Security benefit from $16,150 to as low as $4,250. That is nearly $12,000 in income that disappears from her 1040. At her marginal rate, that is a $1,800 federal tax reduction every year for the rest of her life. The government built the trap. Marilyn never saw it. Today, she sees it. And so do you. Before we go any further, smash that like button right now. Not because it helps me, because there is a Marilyn in your life. A parent, a neighbor, a widow who thinks 70% of her Social Security benefit being taxed is just the law and cannot be changed. That like is the beginning of her finding out she is wrong. Hit it. Let's build the crime scene with real numbers. The suits at the agency want me to remind you this is not financial advice. It is a survival guide for an unguarded vault. Talk to a fiduciary CPA before you move a single dollar. The formula the IRS uses to determine how much of your Social Security benefit gets taxed is called the Provisional Income Formula. It is defined in IRS Publication 915. Provisional income equals your adjusted gross income, not including Social Security, plus any tax-exempt interest you received. Yes, your municipal bond interest counts here, plus exactly half of your annual Social Security benefit. Write that down. AGI minus Social Security, plus tax-exempt interest, plus half your Social Security. That is your provisional income number. Now apply the 2 thresholds. If your provisional income lands below $25,000 as a single filer, or $32,000 as a married couple filing jointly, 0% of your Social Security benefit is taxable. 0. If your provisional income is between $25,000 and $34,000 as a single filer, or between $32,000 and $44,000 married, up to 50% of your benefit becomes taxable. If your provisional income exceeds $34,000 single or $44,000 married, up to 85% of your Social Security benefit is taxable at your ordinary income rate. Those thresholds, $34,000 and $44,000, were written into law in 1993. The Consumer Price Index has risen 125% since 1993. If the $44,000 married threshold had been indexed to inflation the way nearly every other provision in the tax code is indexed, it would sit at approximately $99,000 today. Instead, it sits at $44,000, frozen, while your income, your RMDs, your pension, and your Social Security COLA increases have all grown. That gap is not an accident. It is a revenue mechanism. Every year the thresholds stay frozen, more retirees cross them. More Social Security gets taxed. more money flows to the federal treasury from the benefit you paid into across an entire working life. Now let's run Marilyn's numbers. Marilyn's adjusted gross income from her IRA distribution is $36,000. She has $8,400 in municipal bond interest from a bond fund her broker sold her 8 years ago, and here is the first knife in the kidney. She chose Muni bonds because she believed they were tax-free. They are exempt from federal income tax on the interest itself, but under the provisional income formula, that $8,400 still counts. It flows directly into her provisional income calculation as if it were fully taxable ordinary income. The tax exemption on the interest disappears the moment you apply it to Social Security. Her annual Social Security benefit is $22,800. Half of that is $11,400. Provisional income, $36,000 plus $8,400 plus $11,400 equals $55,800. At $55,800 in provisional income as a single filer, she is well above the $34,000 upper threshold. 85% of her Social Security benefit is taxable. That is $19,380. Her tax preparer actually ran a slightly different calculation based on the IRS worksheet in publication 915 CHIR, arrived at $16,150 taxable. But the point stands. The majority of her benefit is taxed, the benefit she earned, the benefit she paid for, the benefit the government told her was her security. Stealth tax layer 2. Her taxable Social Security income pushes her total AGI high enough to phase out certain deductions and credits she would otherwise qualify for as a senior. In Arizona specifically, this matters. The state allows a $2,100 exemption for taxpayers over 65, but the federal AGI that triggers it is calculated after Social Security taxation runs. Her window for certain credits compresses. Stealth tax layer 3. If Marilyn were also enrolled in Medicare, which she is, her provisional income calculation is the same income base that determines her IRMAA Medicare surcharge. At $55,800, she is above the base IRMAA tier for a single filer. Her Part B premium is not $185 per month. It is $259 per month. The provisional income trap and the IRMAA trap are the same trap, fired by the same trigger. I want to hear from you right now. Drop your answer in the comments. How old are you today? June 25th, 2026? And do you know your provisional income number? Not your gross income, not your AGI, your provisional income, AGI minus Social Security, plus Muni bond interest plus half your benefit. Drop that number. If you don't know it, drop a 0. Because that 0 tells me exactly what your tax preparer has not been doing for you. Now let's go back to where this started. Because the provisional income formula was not invented by the IRS, it was written by Congress. And the original intent was explicit, documented, and radically different from what it does today. In 1983, Ronald Reagan signed the Social Security Amendments of 1983, Public Law 98-21, based on recommendations from the National Commission on Social Security Reform, chaired by Alan Greenspan. The trust fund was in crisis. Congress needed revenue. The compromise they reached was historic. For the first time in the program's 48-year history, Social Security benefits would be subject to federal income tax, but only for high earners. The threshold they set, $25,000 for single filers, $32,000 for married couples. The explicit legislative intent, stated in the committee reports recorded in the Congressional Record, was to tax only the top 10 to 15% of Social Security recipients, the wealthiest retirees, the ones with significant outside income on top of their benefit. 10 years later, in 1993, the Clinton administration added a second tier during the Omnibus Budget Reconciliation Act of 1993. For households above $34,000 single or $44,000 married, the taxable portion of Social Security increased from 50% to 85%. That second tier was also targeted, designed to capture higher income retirees, to generate revenue for the Medicare Hospital Insurance Trust Fund. The legislative record again states this plainly. It was intended for upper-income beneficiaries. Neither threshold, 1983 or 1993 DAS, has ever been indexed to inflation. The median household income in the United States in 1983 was $20,885. The $32,000 married threshold was 53% above median household income. It was genuinely a high-income threshold when it was written. Today, the median household income in the United States exceeds $74,000. The $44,000 married threshold sits at 59% of median household income. The threshold designed to catch the wealthiest retirees now captures a retiree couple earning less than the national median. Who profits from this architecture? The federal government collected approximately $50 billion in 2024 from Social Security benefit taxation, a number that has grown every single year as more retirees cross frozen thresholds. That $50 billion flows into the Social Security Trust Fund and the Medicare Hospital Insurance Trust Fund. Congress has strong fiscal incentive to leave the thresholds exactly where they are. The mutual fund industry profits because the solution most retirees reach for, municipal bonds for tax-free income, actually worsens the provisional income problem, as Marilyn discovered. The Muni bond sales pitch does not include the footnote about provisional income treatment. Your broker is not required to disclose it. Many brokers don't know it themselves. The tax preparation industry profits because provisional income complexity creates perpetual dependency. A retiree who understands the formula can often manage it themselves. A retiree who doesn't understand it will pay for help every April, without understanding whether that help is solving the problem or simply reporting it. Send this video to one retiree right now, not tomorrow, today. The one who told you their Social Security is taxed and they don't know why. The one who bought Muni bonds thinking they were solving the problem and made it worse. You already know who that person is. Send it to them before you watch another minute. I'll wait. Now let's dismantle the trap. 4 moves, in order of impact, for Marilyn and for you. Save this video to a playlist titled Retirement Survival Manual right now. Every strategy in this section connects. You will want to be able to return to it. Move number 1. Roth conversion ladder. Drain the provisional income fuel tank. What it is, a Roth conversion is the act of moving money from a traditional IRA, where every dollar of distribution adds to your provisional income, into a Roth IRA, where qualified distributions are permanently excluded from gross income, excluded from AGI, and excluded from the provisional income formula entirely. Why it is dangerous to ignore, every dollar sitting in Marilyn's traditional IRA is a future provisional income landmine. When she turns 73 and required minimum distributions begin under the Secure Act 2.0 schedule, she will not choose how much to pull from that account. The IRS will tell her, and that mandatory distribution, calculated against her full account balance using the Uniform Lifetime Table, will be added to her provisional income whether she needs the money or not. At her current balance and projected growth rate, her first RMD could exceed $26,000. Adding $26,000 to her current provisional income does not just increase her Social Security tax, it potentially triggers a higher IRMAA tier. Both doors slam at once. The exact escape strategy: begin a Roth conversion ladder now, before RMDs are mandatory. The strategy is to convert a calculated amount each year from the traditional IRA to a Roth IRA, targeting a provisional income number that keeps the Social Security taxable percentage as low as possible, ideally below the $34,000 single filer cliff. For Marilyn, that means calculating her maximum allowable conversion each year by working backward. Start at the $34,000 threshold, subtract half her Social Security benefit, $11,400, subtract her Muni bond interest, $8,400, and the remainder is her conversion headroom. In her case, approximately $14,200 per year before she hits the 85% taxation zone. Convert that amount annually, pay the tax at today's rate, and shrink the future RMD bomb. The Roth conversion itself does not count as provisional income in the following year, only in the year of conversion. Once funds are in the Roth, future distributions are invisible to the provisional income formula. The conversion is a one-time tax event that permanently removes the underlying asset from the trap. State-level nuance. In Arizona, Roth conversion income is taxed at the state level. Arizona has a flat income tax rate of 2.5% as of 2023 forward under Proposition 132. This is among the lowest state income tax rates for IRA conversions in the country, making Arizona one of the most favorable states for executing a multi-year Roth ladder. By contrast, in California, the same conversion is taxed at ordinary state rates up to 13.3%, making the calculus significantly different. A California retiree in Maryland's situation should model the conversion over a longer timeline at smaller annual amounts to minimize state tax drag. In Ohio, IRA distributions, including conversions, are subject to state income tax at graduated rates, though Ohio's senior lump sum retirement credit can offset a portion of the tax for qualifying taxpayers. In Florida, there is no state income tax. The Roth conversion is a federal-only event, and the math runs cleanly. Florida retirees in the provisional income trap should be executing this strategy aggressively. Move number 2, qualified charitable distribution, the invisible RMD. What it is, under IRC Section 4, 08D8. Referenced directly in IRS Publication 590-B, a taxpayer age 70 and a half or older may transfer up to $105,000 per year directly from a traditional IRA to a qualified 501(c)(3) charitable organization. That transfer satisfies the required minimum distribution obligation for the year, and it never enters gross income. Why it is dangerous to ignore. The QCD is the single most powerful provisional income suppressor in the retirement tax code. A retiree who takes their RMD as a normal distribution and then writes a check to charity gets a charitable deduction. But that deduction only helps if they itemize. And the standard deduction for seniors in 2026 eliminates itemizing for the majority of middle-income retirees. The QCD is not a deduction. It is an exclusion. The money never appears in AGI at all. It is invisible to the provisional income formula before the formula can even start. The exact escape strategy for Marilyn, who will face a mandatory RMD of approximately $26,000 at age 73, directing even $15,000 of that distribution as a QCD to a charity she already supports. Her church, her library foundation, her grandchildren's school, eliminates $15,000 from provisional income. That alone can move her from the 85% Social Security taxation zone back into the 50% zone, saving her between $800 and $1,400 in federal taxes annually. The mechanics: instruct your IRA custodian to issue a check payable directly to the charity, not to you. A check payable to you that you then endorse to the charity disqualifies the QCD. The payment must flow directly. Get the direct transfer form from your custodian in October. Don't wait until December when processing backlogs can miss the year-end deadline. State-level nuance. In Arizona, the QCD exclusion mirrors the federal treatment. The distribution never hits Arizona gross income either, making the state benefit additive to the federal saving. New Jersey is more complex. New Jersey does not conform to all federal IRA rules, and the QCD treatment at the state level requires confirmation from a New Jersey-licensed CPA familiar with the state's decoupled provisions. In Ohio, the QCD is generally respected at the state level for residents who are itemizing, but the senior retirement income credit calculation may be affected by the reduction in IRA income, a nuance that can be modeled to your advantage. In Texas and Florida, with no state income tax, the QCD is a clean federal win with zero state complications. Move number 3, repositioning muni bonds, cutting the phantom tax. What it is: the repositioning of tax-exempt municipal bonds or muni bond funds held in taxable brokerage accounts into alternative income-producing assets whose interest or distributions do not feed the provisional income formula. Why it is dangerous to ignore. Marilyn bought muni bonds to reduce her taxable income. It was a rational decision based on incomplete information. The interest she earns on those bonds, $8,400 per year thus, is exempt from federal income tax on her 1040, but it is not exempt from the provisional income formula. It flows into the calculation at full value, exactly as if she had earned it in a regular taxable bond fund. She is paying a provisional income penalty on money she thought was completely protected. This is the phantom tax. She is not taxed on the muni interest directly, but that interest increases the taxable percentage of her Social Security benefit, costing her real dollars on a different line of her return. She is paying an indirect tax on income she was told was tax-free. The exact escape strategy: Two options, depending on her broader situation. Option A. If Marilyn has room in a Roth IRA or has completed sufficient Roth conversion to hold bond-like assets there, repositioning the Muni bond fund into a Roth removes the provisional income contamination entirely. Inside the Roth, there is no provisional income contribution from any distribution. Option B. If holding inside a Roth is not available, consider a shift to growth-oriented index funds in the taxable account, assets that produce minimal annual income and whose gains are realized only upon sale, giving her full control over the timing and amount of income each year. An index fund that throws off 0.3% in annual dividends contributes far less to provisional income than a bond fund yielding 3.5%. State-level nuance. In Arizona, muni bond interest from in-state bonds is also exempt from the Arizona flat tax. An additional reason why the hidden provisional income cost stings more. Maryland is getting a real state tax benefit but paying a federal provisional income price that erodes part of the gain. In California, in-state muni interest is exempt from the state's 13.3% top rate, a very real benefit, but the provisional income problem is identical at the federal level. California retirees need to model whether the state tax savings on muni interest outweigh the provisional income increase on a dollar-for-dollar basis. In most cases, for retirees already above the $34,000 provisional income cliff, the math favors repositioning. In New Jersey, out-of-state muni interest is fully taxable at the state level, making the muni bond strategy doubly flawed for New Jersey retirees with high provisional income. They are paying state tax on the interest and getting a provisional income hit at the federal level. Move number 4. Social Security timing optimization. The benefit amount is the multiplier, what it is. The recognition that the size of your Social Security benefit, determined by the age at which you claim, directly multiplies the scope of your provisional income exposure, and that in certain income situations, delaying benefit claiming to age 70 to maximize the monthly benefit actually maximizes the provisional income trap rather than defeating it. Why it is dangerous to ignore. Most financial advice on Social Security timing focuses on longevity break-even analysis. How long do you need to live to make waiting pay off? That analysis does not incorporate the provisional income tax effect. A retiree who delays to 70 and receives $3,200 per month, $38,400 per year, has $19,200 in annual provisional income from Social Security alone before adding a single dollar of IRA income. A retiree who claims at 62 and receives $1,900 per month, $22,800 per year, contributes only $11,400 to provisional income from Social Security. The higher benefit creates more provisional income drag. This does not mean claiming early is always correct. It means the provisional income impact of your benefit size must be part of the timing calculation, not an afterthought. The exact escape strategy. For retirees who have significant traditional IRA assets and expect large future RMDs, delaying Social Security while executing a Roth conversion ladder creates a window, typically between age 62 and 70, where IRA income is voluntarily taken at controlled amounts for Roth conversion, provisional income is managed deliberately, and Social Security is withheld until the Roth balance is large enough to absorb future RMDs without provisional income contamination. This is the two-lever strategy. Pull the Roth conversion lever down while holding the Social Security lever up. When you release Social Security at 70, your IRA balance is smaller, your future RMDs are smaller, and your Roth distributions are invisible. The higher Social Security benefit lands in a lower provisional income environment. State-level nuance. In Ohio, Social Security benefits are fully exempt from state income tax, making the provisional income fight a purely federal battle for Ohio retirees. The Roth delay strategy is particularly powerful in Ohio because state tax is not a factor in the conversion math. In Arizona, Social Security is also fully exempt from the state flat tax. Same advantage. In New Mexico, however, Social Security is partially taxable at the state level for higher income retirees, adding a third layer of taxation that makes provisional income management even more critical. New Mexico retirees should be working with a CPA who understands both the federal provisional income formula and the state's Social Security exemption phase-out. In Vermont and West Virginia, state taxation of Social Security has been gradually reduced through recent legislation, but rules vary and should be verified for the current tax year. Marilyn Kowalski is going to sit down with a fiduciary CPA before the end of this summer. She is going to calculate her provisional income number for the first time, the real number, with the Muni bond interest included, with half her Social Security counted. She is going to see exactly which tier she is in. She is going to model a 3-year Roth conversion ladder that keeps her just below the $34,000 cliff. She is going to direct her first QCD to the Scottsdale Library Foundation, the same system she served for 29 years. And she is going to request a share class audit of her brokerage account and a repositioning proposal that reduces her annual provisional income contribution by at least $8,000. If she does these 4 things, Marilyn recovers approximately $1,800 per year in federal taxes she did not legally have to pay. That is $1,800 she sends to her daughter instead of to the IRS every year for the rest of her life. It is June 2026. The provisional income calculation for your 2026 tax return is being built right now by every distribution you take from your IRA this year, by the Muni bond interest accruing in your taxable account, by the Social Security deposits hitting your bank account every month. The window to reshape that number is this calendar year, not next year, not when you file in April. Now, the $44,000 married threshold is not going to move. Congress has had 33 years to index it and has declined. The provisional income formula is not going to be simplified. The Muni bond disclosure gap is not going to be fixed by your broker. None of these structural traps self-repair. They collect. Every month you do not act is a month the formula runs against you by default. The Roth conversion window that exists before your RMDs begin, the years between now and age 73 is not infinite. Secure Act 2.0 pushed the RMD start age to 73 for taxpayers born between 1951 and 1959, and to 75 for those born in 1960 or later. That window is your most valuable asset right now, not your IRA balance. The window to convert it at controlled rates, on your schedule, before the government dictates the withdrawals. Subscribe to this channel right now. This is the archive. When Congress adjusts the provisional income thresholds, if that day ever comes, you hear it here within 48 hours. When the IRS updates Publication 915 for a new tax year, this bulletin finds you before your tax preparer does. When IRMAA thresholds shift and the provisional income interaction changes, you are not the last to know. Hit subscribe, hit the bell, join the watch post, and share this with Marilyn. You know who Marilyn is. She is in your contacts right now. She has been paying a tax she didn't fully understand on a benefit she spent her career earning because nobody sat down with her and ran the provisional income formula out loud. You can be the person who changes that. Send this video today. Be Marilyn who ran the numbers and changed the outcome. Don't be Marilyn who kept letting the formula run unchallenged. I'll see you in the next bulletin.